Hi, Todd Pouliot with Gateway Financial. Again, mygatewaymoney.com is our website. Feel free to visit us there. First of all, I just, again, wanted to say thank you for allowing us to keep doing these flow charts and checklists. Appreciate you all sharing them and subscribing. It means a lot to us, and we'll keep bringing you this content. As long as you keep responding to us, we appreciate it. Been getting a lot of emails and requests for different flow charts and checklists that people would like to see. And we're trying to make these videos as basic as we can so the regular person can understand them and learn from them. So we appreciate your feedback on what's going on here with these flow charts and checklists. Today is a little bit different, but one that's imperative to most people once they're done and retired. So reviewing a tax return for a client is informative exercise. And it ensures that we understand all the sources of income and tax liabilities for the prior year. This is true not only for existing clients whom we've been working with, but it's especially true for new clients as a way to familiarize ourselves with their situation. This checklist, we're going to highlight a few points to consider on your tax return if you're retired. We have a separate checklist for people who are working in that 1040 review, but this one is specifically geared towards people who are retired. First of all, I want to review these filing status. If you're married, should you automatically file jointly with your spouse, or might there be a solution where the client might consider filing separately? And if the client is divorced or widowed, there's filing steps to take depending upon the timing and the circumstances of that. And if the client had investment income from the prior year, there are reporting issues that we want to make sure are addressed in connection with this income. And if the client owned a tax advantage account during the prior tax year, typically think 401ks or IRAs, 403bs, there may be some reporting issues to consider, especially if you took any distribution from these accounts. For clients who have reached their RBD, or required beginning date, did they take the full amount of their RMD, required minimum distribution, from their retirement plan? Did you roll over an IRA? Were there any distributions taken from an after-tax IRA account? And we want to also see if you have a high level of medical expenses, and if so, are there any state-specific issues that we need to consider? And as we always do, we're going to share our screen with you. Typically, how this works with our clients is we email them a live version of this, and the checklist has these little check boxes where they can check yes or no on these issues, and we can go and review each specific item with them as that goes through. Again, this is for 2022. We'll try to update this next year, but as 2022, reviewing the 2021 tax return. Did you take any standardized deductions? Again, 12.5 or 25.1 for married filing jointly. Make sure that you have your cash contributions to certain qualifying charities. It's $300 or $600 if married filing jointly. What a great way to donate to a charity and get a tax deduction for that. And in the future, you might want to consider bunching or bundling those contributions or certain expenses, including those medical expenses or property taxes, into one tax year. It may allow you to itemize if that goes above those standard deduction amounts for 2021. And are you married, and do you want to protect yourself against liability issues? Sometimes there is a large disparity between the husband and wife on incomes. So that's why we don't want to automatically select married filing jointly. Sometimes married filing separately may reduce your net tax liabilities and may allow you a smaller tax liability there. So are you recently divorced, or has your spouse passed away? Please review the filing status. So many times we see errors on these. Some people are do their taxes on their own, or they have a CPA that might not be aware of a divorce or a deceased spouse. And have you been divorced? Depending on the divorce decree and the agreement date, review these dates. They are very important. Was it after 2018? The alimony is not deductible by the payor or taxable to the recipient. That law has changed, so make sure you look at your dates there. And if you enter divorce agreement before, make sure you're looking at Schedule 1, line 19, and for the recipients, Schedule 1, line 2A on the taxability of those. Were you eligible for the economic impact payment of 2021? May claim recovery on 1040, line 30. So if you were eligible and did not receive it, you may claim a recovery rebate credit there. And was there any AMT, alternative minimum tax, Form 6251? Review the strategies that we have to reduce AMT, such as minimizing large capital gains or harvesting losses. So much of financial planning is based on tax planning. And it's so hard to understand that a lot of tax preparers don't do tax planning. They're just going through the history of what happened and keeping score like at a baseball game. They won't go through and look at tax planning and say, should I start a left-handed pitcher or a right-handed pitcher, or do I put in a pinch hitter in this situation, or steal, or how do we manage or plan the game? So make sure you understand what's going on with AMT and look at how those investments are being dealt with by the financial advisor or the advisor that's doing their investments. And if you paid a significant amount of AMT in 2020, check Form 8801 to see if you received a credit. Also, are you and your spouse 65 and over, and is your spouse blind? So there's some different issues that we looked at for deductions for taxpayers and unmarried taxpayers and disabled taxpayers. Did you owe more tax, or did you receive a higher refund than expected? Determine if this is due to unique circumstances, such as a sale of a highly appreciated investment, by comparing taxable income from the last 2 years' tax returns. Again, that's where the tax preparer is vitally important to look back and then also figure out what are we going to do for 2022 in planning for taxes for next year. And did you fail to withhold enough tax, or did you underpay your estimates? Review Form 2210 and 1040, line 38 to see if you had a penalty. Not paying enough taxes does incur a penalty, so make sure you have that prepared properly and also planned for properly. Investment income issues. Is any interest being reported? Line 2A and 2B, and are dividends being reported? Lines 3A and 3B. If so, we have Schedule B that we need to review, and what accounts are generating those income, and was the interest taxable or tax exempt, and if the dividends are ordinary or qualified. Boy, that's a mouthful, but I will tell you, one of the things that I get concerned about, and mostly clients really get concerned about, we've had a down market in this year, and I'm paying all these capital gains taxes. Where is all this coming from? Understand how your investments are working, the mutual fund, and how those are spinning off income when you are losing possibly in that investment. So understanding those 2A, 2B, 3A, 3B, and how substantial those can be within your tax return. And is your modified adjusted gross income above 200,000 or 250 for married filing jointly? And do you have net investment income? This is that extra income of 3.8%. So make sure you understand how to keep that number, that modified adjusted gross income, below that 250 if you're married filing jointly, or 200 as a single tax filer, and how to avoid or not have to pay that extra 3.8% if you don't need to. And were there any capital gains, and also most importantly, or losses? Again, that's line 7. Going through each individual line, there's so much we can see and learn and determine from each individual client. So line 7 teaches us quite a bit. Schedule D, line 13, and Schedule D 6 and 14 for short-term and long-term loss carryovers, and ensure we've been carried over from the previous tax return. Boy, I would hate to see all those losses just disappear and not used. That's why you really want to have a very good CPA that's reviewing your tax return and utilizing that information for the planning for the next year. Page 2. Did you reach your required beginning date in 2021 or before Or do you have an inherited IRA? Again, we have a completely separate issue here with the Secure Act and understanding how those go, but make sure your RMD has been satisfied and it has been reported on 1040 line 4A and 4B. It is the most damaging tax torpedo in the tax code, 50% penalty if you miss your RMD. So be cognizant of that. Very important issue to make sure you're taking care of those. And what we do for our clients is we almost automate those so we can take them early, efficiently, and make sure that we never have to deal with that penalty. 70 and a half. Again, this is prior to that RMD change with the Secure Act. Qualified charitable distributions is a different age than that 72 for the RMDs. Make sure it's properly reflected with the amount on 1040 line 4B. And have you ever made a non-deductible IRA contribution? Form 8606, quite popular for people with high incomes to make a non-deductible IRA contribution. Make sure the cost basis is being tracked properly. The custodian should be doing that. Make sure that the custodian of your funds, be it Charles Schwab or Fidelity or TD or SEI or whoever you're using as your custodian, just to name a few, is really tracking that cost basis. And did you withdraw money from an IRA that holds after tax contributions? Again, that's that form 8606, such an important form most people don't know a lot about. It ensures taxable and non-taxable positions that were distributed and were they calculated correctly. Convert amounts by a traditional IRA to a Roth IRA. This is tax planning 101. Every year we take our 1040s that we get from our clients, we upload them into a software and we review, is this the right time and how much should we turn into a Roth IRA conversion? And that conversion can be quite significant or little depending on the tax brackets and how that affects IRMA or Medicare premiums. Make sure you really, this is tax planning 101 and basic blocking and tackling that needs to go along. Did you roll over retirement funds during the year from one account to another? So 401k, roll over into an IRA. Make sure that those are tracked and everything is perfect. And I prefer if you do a trustee to trustee transfer. Again, line 4A, the amount of the rollover, and 4B should be 0. If not, taxable distribution occurred. Make sure you understand that. And again, we're doing this for the retiree, but if it's before 59 and a half, we don't want to pay any extra penalties. Did you roll over retirement funds and utilize NUA? Boy, I love this one. This is one of the ones that I need a bib. I'm salivating if this works out for the right client. NUA is net unrealized appreciation, line 5A and 5B, and make sure the basis was taxed properly. Net unrealized appreciation for company stock is a wonderful tax tool to use. And if you're not utilizing it properly for your company tax, shame on you. It's a wonderful, wonderful tool. And did you take coronavirus related distribution from an eligible retirement plan in 2020? And did you spread the tax over 3 years? Checks lines 4B and 5B to make sure the taxable amount is reported and reported properly. It was a wonderful way for people that had these coronavirus related distributions to spread that tax out over several years instead of taking that big chunk and that big hit all at once. Again, that's tax preparation and planning in one thing that needs to be done together. Did you take a non-qualified distribution from a 529 account? Make sure you have form 5329. That will calculate the penalty. And it's schedule 2 is where that information is carried over to on line 8. And we do have a flow chart on that. I don't think I've done that one yet for a video, but I will have that up here shortly for you. Large medical expenses, schedule A, line 1. Medical expenses in the deduction limit. Remember that Medicare premiums and long-term care premiums, make sure those get counted. A lot of times those are left out of that line, and that could really help you back on the checklist. We were talking about standardized versus doing a full schedule A for itemizing tax deductions. And are there any state-specific issues that you have? There's tax benefits to retirees, such as not taxing Social Security or pensions. That's a big conversation to have. Hey, I'm going to retire and I want to move to here or here. Which state do you want to move to and why? Look at each state and how they tax things. It could mean thousands of dollars in changes of income on whether or not Social Security is taxed or not. And do you own real estate? Review Schedule E, see what expenses you can deduct on your rental property. That would be wonderful to see if you could deduct those on rental properties that you have. Some people have several rental properties and could be in different states. So make sure you understand what those are. Again, I just wanted to say thank you. You guys keep showing up and watching these videos, and hopefully we're doing a great job for you and helping you explain these in kind of layman's terms. But reviewing that tax return is vital. It is vitally important, especially to a retiree. I don't ever want to go back to work is a comment that we hear. So let's take advantage of the tax laws that are in place and take advantage of the opportunities that are available to you and make sure you do the best you can. And I think that's what people come to us and say is, am I doing the best I can on my tax planning? Am I doing the best I can on all of my investments? And are my investments being tax managed properly? Are my investments being handled properly? Not just in the tax allocation, but also tax location for those assets. Boy, I would hate to see you municipal bond in a qualified IRA. That is the wrong location for that asset to be put in. So make sure the assets are put in the right location along with tax asset allocation. So again, thank you so much for being here. We much appreciate it. Keep that thumbs up. We really need those thumbs up. We need subscribers to help this video get out there, and we can help as many people as we can. And you guys all have a wonderful day and be well.